We've just opened up the webinar and we're just waiting for people to join. Once a significant number have joined, then we will start. Welcome everybody to this, our second virtual tax analysis after the budget. Starting with our usual disclaimer, just to make sure that you all are aware that this is not formal advice. And if you take a wrong step as a result of my good humor, we are certainly not liable for that. Formal advice needs to be taken for proper tax strategy and planning. So a big shout out to our Durban office as we reach our milestone of 100 years young this year. And with that, we developed the cover slogan of "With adaptability comes longevity," as a remembrance of how we have gone on this journey as the Durban office from our beginnings as David Strachan and Taylor, and how our country has always adapted during its transitional periods, remembering also Peter Dirk Ace and Adapt or Die, and most certainly also the legacy of the Arch, who we've recognized in our cover and whom we hope you also identify with and donate to the worthy cause of their foundation. They were a compass for our morality, something we also need to remember when looking at tax and what is happening in the world of tax. Today, I will do the presentation for about an hour, and thereafter our panelists, who you can see on your screens at the moment, will be willing and able to answer questions that you pose. So we encourage you to use the chat line and to use the question box to raise questions that you would like to be considered. Some of these might be answered by Alexa, who's working in the background, and some of them might be responded to with an encouragement to come into our offices rather for a proper answer. But more of that later. When one looks back in history and has the benefit of hindsight, one has to wonder whether things are a coincidence or not. So the day after the Archer's funeral, Parliament was in flames. Was that a coincidence? Was it linked to his anger at the ANC when the Dalai Lama was not allowed to visit, and his anger at what was happening with corruption and the lack of activity from Parliament in that regard? Parliament was opened this year with the State of the Nation address in the Cape Town City Hall, where almost to the day, Mandela made his first public address after 27 years in prison. Is that a coincidence? And certainly we have the Sona plan tabled by President Ramaphosa, but not of the magnitude of that opening address by Mandela, and not of the young Cyril Ramaphosa when he was the General Secretary of the National Union of Mine Workers. All we have is a plan about a plan, and a plan about an old plan of how hemp is going to change the world. We need more. We need to have proper reports on the progress that we as a nation have taken from one State of the Nation address to the next. What's happened to that smart city? What's happened to all those job opportunities? We need to have more, Mr. President. The medium-term budget set out certain strategic goals that we as a country should be taking to regenerate the economy and to gather that necessary growth that we need. These were repeated again in the SONA, but no real progress on where we are. The one very important new scheme that was highlighted in the budget speech is the bounce back scheme to support small, medium enterprises. It's similar to the COVID loan relief that was granted through the banking system, where government underpinned and underwrote some of the debt. Here, government, through the banking system once again, is going to make some 15 billion rand available through the banks, underwriting the first 20% of any losses by the bank. And this should be launched in the next month. This is real progress as the small business sector battles to get the necessary funding from the banks, but with this form of guarantee in place, they truly can generate those necessary jobs to stimulate the economy. We had the Zondo Commission. We've had 2 of the 3 reports, and yet we are still no closer to a resolution of what is going to happen there. The minister in his speech highlighted that corruption was lowering our economic growth and ensuring that our state does not have the necessary potential to develop. We need to address this properly. And now, Mr. President, is the time for proper action in this regard. And yes, you can generate that local business making orange overalls ready for use. And during this process, we are going to see some old tax law, which will be refined, going back to an old case of COTVG, a Zimbabwean case, which looked at whether stolen proceeds were in fact gross income or not. And some iterations that have happened since then. But more importantly, Interpretation Note 80, issued by Sars, where they hold the line that stolen funds will constitute gross income because the intention of those who stole was to retain those funds for their own use and for their own benefit. And in the speech, taking a step back from the whole secrecy provisions, clearly setting out that in the Estonia dairy project, VAT fraud charges and foreign exchange contraventions are going to be pursued. We must remember our past. However disillusioned we are with the progress, as the minister said, we have been on this journey for a long time, but we still have a long distance to walk. Not so long ago, in 1962, on this very day, the 24th of February, a young colored journalist, Joseph Lowe, was sentenced to 6 months for a breach of the Immorality Act. We don't even know what that means, with our children mixing, mingling, marrying across color lines. Our world is so different to what it was in 1962. And in 1992, it's not so long ago that the country went through the referendum to give de Klerk the mandate to negotiate with the ANC, and the ANC set forth its proposals for CODESA. It is not so long ago, and yet so much has happened, both in this country, both with technology, both with development. We must remember that when we are in our negative state. So we have the medium-term budget, which sets a foundation of what we can expect in the budget. And we hear then, and we heard again now, about the number of people that are on the COVID 350 Rand a month grant and the general social grant. Some 38 million people are on that grant. And the extension of the 350 Rand a month grant is going to cost some 44 billion Rand. So when people ask for a higher grant, one must put that in a level of context as to where that money is going to come from. Because we only have 15 million taxpayers registered, of which about 7.7 million, just over half, don't pay any tax because they earn below the threshold. It is unsustainable to expect so few taxpayers to carry so many people on the grant. We need growth. We need growth in the economy to break the cycle of poverty and unemployment, because we're spending more on debt than we're spending on the necessary services of health, of the police, or of basic education, as the minister once again highlighted in this budget speech. He also highlighted something which is important for us to remember, that if we want to generate 50 billion, which is roughly what that 350 Rand a month extra grant is costing, then that equates to a 2% increase in the VAT rate, or a 2% increase on the top marginal rate. But he also highlighted that the last time the top marginal rate increased from 41 to 45%, the level of taxable collections was not as high as what was originally anticipated. There is a level when the tax increase does not work, and we are at that level now. So let's look at some of the detail of what actually happened yesterday in the budget. So we have the medical tax credits. We have an inflationary increase, which was unexpected because we've heard about national health insurance coming through, and the expectation of some was that there'd be no change to this medical credit as a phase-out process. Luckily, that did not occur. We had no changes to the top rates for individuals and no changes to the tax rates of trusts. Also, no change to the capital gains tax, either the inclusion rate or the thresholds and the rebates. But no change is better than a negative change. And when it came to the rebates, we had a significant improvement on the rebates and the bands and the brackets to cover bracket creep, where you pay more tax because of the increases that will come through in salaries this year. And to account for that, that's a 13 billion Rand saving that's been passed through to individuals by the change in those table rates. And that's significant, because that was a silent way that government could collect more money by not adjusting for bracket creep. And yet there's a significant change that's been made there. Also, very important, the change to the employment tax incentive, allowing another 2.2 billion Rand to be allocated to enhance that incentive. And I'll look at that in more detail later. Transfer duty, no change, and there hasn't been a change for some time, but with the economy where it is, one wouldn't have expected a change upward for transfer duty. Estate duty and donations tax, no changes there, but I'll highlight later why I think things will be changing in the not too distant future. And the VAT rate at 15%, there's an election within the ANC this year. We are 2 years off a national election. One wouldn't really have expected there to be a change in that rate. And the dividend tax rate, no change there. Once again, those changes are fairly entrenched, and we are within the world norms for those taxes. This is the very first year since 1990 that there's no general fuel levy increase and no road accident fund increase. And that's effectively saving 3.5 billion Rand through the fuel levy adjustments. The general sin taxes, one expects nothing less they would always go up. And now there's a new category added from January 2023 for those who vape. A very good new addition to the sin taxes. Sadly, the sugar tax increases again, putting more pressure on those of us who like our Natal sugar. And the tax-free savings have not increased, but that still is a relatively generous allowance that has been paid and something that people should be doing on an annual basis. Limited relief for the small business just to account for the rate changes, but one hopes that there is a proper review of some of the thresholds, which will hopefully provide some greater allowance and relief for small businesses. But the most important adjustment that came through is the final change to the corporate tax rate. We started hearing about this last year with the intention to reduce the rates and the intention to change the assessed loss and some of the the interest deductibility formulas. These were deferred and delayed and linked together in a proper manner. So for 2021, we didn't have a deferred tax because there was no clarity on the rate of change in the corporate tax. But now there's clarity, and the draft bill indicates that the change is happening on the 31st of March 2023. So we now have the reality of the reduction in the corporate tax rate, and that is going to cost some 2.6 billion. And the minister, when he highlighted the OECD averages of 23%, is giving a signal that this is possibly not the last reduction in the corporate tax rate, and probably as certain of the specific incentives reverse, reduce, and are removed, there will be further changes to the corporate tax rate. And so linked with the reduction in the corporate tax rate, we already have the law of the change in the assessed loss rules. The law is there and was waiting for the date when the corporate tax rate changed. So for years of assessment ending on or after 31 March 2023, the adjustment is coming through that your assessed losses will be ring-fenced and rolled over. So you'll only be allowed 80% of your taxable income before the assessed loss as an assessed loss carry forward in that year. But there's the proviso that if that assessed loss was less than R1 million, there's no reduction. So for the smaller companies with smaller assessed losses, life will be relatively simple. For those with larger assessed losses, you'll be paying tax on 20% of your income when this provision comes through, even though you had an assessed loss as part of a smoothing and sort of minimum tax recovery by companies. This change with the assessed loss only affects corporate taxpayers. And similarly, we already have interest deduction limitation with payments to non-residents, but the formula will be amended once again linked to the change in the reduction in the corporate rate. And this will generate some 1.5 billion rand. So the understanding of National Treasury is that the reduction in the corporate tax rate is balanced from a collection point of view between the change in the assessed loss rules and the change in the interest deduction rules. Now, revenue has already started improving its auditing and has generated much more income than was anticipated, both due to the enhanced auditing and due to the mining company boost with its turnover. But the lifestyle audits are certainly going to become more and more within the scope of Sars. And as part of that process, there's now talk that comes through from the budget review that there'll be new laws and new disclosure requirements for high net worth individuals who have assets of more than 50 million rand, having to disclose the market value of those assets. I think we'll deal with that a little bit more, because I'm sure there'll be some questions that will arise in that regard. But what it does mean is that there is going to be more disclosure. More disclosure has consequences if you don't make that disclosure, and more disclosure will lead to more information being known by SARS of taxpayers and their ability to then plan possible wealth tax rules from that new information. So this is certainly a big change that is looming. It's going to mean that for those people, your tax returns will cost more to prepare. We hope to have proper engagement with SARS and National Treasury, because you can't do proper valuations of your private companies on an annual basis. So we need to find out exactly what those rules are. But there will be more disclosure requirements coming forward on assets and liabilities. Linked to this, SARS is also properly auditing those payments received by companies from national and provincial government from their tenders. SARS wants to ensure that the tender income is reflected in taxable income, and to ensure, therefore, that SARS recovers the tax portion on the profit of the tender income. This is a very important step to ensure that the tenderpreneurs are paying the tax required on their tender profits. Now, common reporting has been with us for a little while, and SARS is now gathering returns of information from other countries. It is only a matter of time before you start getting questions about that income from that other country that you thought was never going to be found by SARS. One needs to make a determination before SARS comes to ask you very difficult questions as to whether or not you need to regularize those disclosures. That can't be dealt with in this question and answer session. That certainly is going to warrant proper consultation with your tax practitioner. And linked to this is the risk area of transfer pricing. The divisions in SARS that are going to monitor all of this sort of information are also monitoring companies that ought to have made transfer pricing disclosures, reports, and have policies in that regard. We can assist with the necessary expertise to provide you with the benchmarking of your transfer pricing. This is very important for those companies that are operating cross-border. And so we've had tax-free countries for many, many years. But the world has now said through the OECD that we are going to look at the digital economy of the world to make sure that that is fairly taxed. And we're going to make sure that countries have a minimum of a 15% corporate tax. By so doing, the hope is that there's less incentive to move things to tax havens because there will be a tax collection throughout the world. And the UAE has begun this process of now having a corporate tax rate from June 2023. This is a very significant step for those who are making use of the UAE as a tax-free economy. Now, the property developers have been within the SARS problem child area for some time. There were some special provisions for temporary letting. They were extended. There was a vacuum period, and now there will be new relief from 1 April 2022. You need to take proper advice as to what you need to deal with when the old rules ended and before the new rules take effect. You'll also need to take proper advice on how to properly implement the new rules, because there are complex adjustments based on cost as opposed to market value, with things changing when you finally sell that property or bring that property back into the back net. This is an area that needs special consultation in order to ensure that you deal with it correctly. Because in general terms, a property developer will have a large financial consequence when they temporarily let their residential units that they were trying to sell. It is important to take advice in this regard, and this is merely to highlight the issue. Now, estate duty is something that we're all going to have to face at some stage. But the real problem is for those who have ceased being a resident, whether they put sufficient documentation before SARS to ensure that SARS is aware that they've ceased being a resident. Because a resident is taxed on their worldwide estate, but a non-resident is only taxed on their South African sourced assets. And so there is that importance that we'll cover in dealing with the ceasing of residency rules to ensure that one is adequately protected in that regard. And I think that there are changes that will be coming on the horizon in this estate duty and donations tax sphere. At the moment, we have an interspousal bequest and an interspousal donation, which is exempt from donations tax or estate duty. I'm not sure how much longer that will remain the case, and one must ensure that both spouses have assets in their estate in case this interspousal donation or bequest is removed. So that is an important planning aspect to look at. Also, as the high net worth section of SARS grows in its competency, they will look at implementing some of the Davis Tax Committee recommendations, especially as Justice Davis is now working closely with SARS and is employed by SARS to ensure the implementation of some of these recommendations. So I think one needs to have a look for those with significant estates, those with significant trusts, to make sure that planning is adaptable to the changes in the law. One can plan for estate planning without trusts. Trusts are but one method, but before trusts were commonly used, preference shares in companies were used. So one ensures that the wealth is transferred to one's children by bringing them in as shareholders early, but ensures that they can't do naughty things in the company by maintaining control through preference shares. One has to do this in a very careful manner because one doesn't want to be seen to have complete control, but certainly there is planning that can take place without trust. And so those people who are averse to trust doesn't mean that you can't do some estate planning. Now, the wheels of justice turn slowly. We've seen that in many of these corruption trials, but equally so here when it comes to tax legislation. Between the budget and the implementation of those laws, it really takes a 12-month period. And so laws that were spoken about in the 2021 budget are only coming through now. We saw then, and we see again in this budget, that some of the special incentives have a sunset clause where they will terminate. Some of these have been partially extended for a short period while National Treasury does its review. Some of those are already ending their lifespan and will no longer be part of statute. And so Revenue have said through this budget, through the minister, that only those incentives that are seen to work will be retained. So we have the learnership allowance, which is very important for the generation of new professionals, new artisans. That has been extended for a limited period whilst this review is on. And the research and development also has been given a slight extension. Those two certainly have impact in the economy, as do the urban development, to try to resuscitate the city centres with new developments. But we'll have to see how National Treasury sees these incentives and whether they will be forfeited for a general reduction in the corporate tax rate. Now, medical disability was part of the discussion in last year's budget, and the rules changed again to allow a simplified method of claiming the school fees where a learner has a disability. And so that's important because you only look to effectively the Model C school closest to you to determine the capped portion, and the excess over and above that will form part of your medical deduction in the enhanced format because you have a child with a disability. Now we're going to see a lot more emphasis on the timing of the lodgement of tax returns, of reconciliations, of IRP5 certificates. All of these are very necessary for the smooth running of the new integrated SARS system, where your information is pre-populated on the returns. The 6-monthly PAYE reconciliation now has the proviso for penalties to be imposed based on the best known information to SARS if you are late in those reconciliations. These can be very, very expensive errors. And the Section 18A donation has become a bit of an industry, unfortunately, with people generating 18A certificates when their organization is not formally registered with SARS to do so. And so what's going to happen now is your certificates will be uploaded by these organizations to SARS in the same manner as your IRP5 certificates are uploaded by your employer, and will finally become part of the pre-populated information of your tax return. It will also allow SARS to clamp down on fraudulent claims for donations. The employment tax incentive is a very, very important incentive to try to encourage employment, but it was being abused. It was being abused by people who are making use of it in order to fund people who were only going to a tertiary educational facility and were never going to enter the employment world. That has been closed, or will be closed, from the 1st of March 2022. And as part of that process, SARS is going to look at extending the understatement penalty rules to apply to ETI abuse. So we must be very careful with the schemes that are being promoted in that regard. I'll look at a few other pertinent issues that have impact for people in their business world. And one of those is the estimated tax assessment. And that will start occurring when you have not lodged a tax return for a number of years. SARS will begin to estimate an assessment. Now, while SARS has the onus to show that their assessment of an estimated assessment is reasonable, you cannot object to those assessments until such time as you actually rectify the wrong by submitting the information that was requested, which gave rise to the estimated assessment, or submitting the outstanding return. It is only then that you have the ability to object to that assessment. And then once again, your time period to lodge that objection is limited. So it's very important that you are monitoring your e-filing when you are in arrears with your tax returns, because once again, you're going to get these pesky penalty assessments raised every month. And second of all, you might very well get an estimated assessment when you don't answer a query, when you don't provide information to SARS, and when you don't lodge a tax return. And this is also the mechanism for the assessments to be raised by the so-called auto assessment process. Now, the fixed amount penalties that you will get as a company haven't changed. That's only if you've got a 2009 or later tax return outstanding, and you've received a specific final demand making reference to the fact that your return is outstanding, and you've been given 21 business days to rectify the situation. You have to have all of those steps in place, and only if you fail on all of those will you be imposed upon you a special fixed amount penalty for the non-submission of the corporate tax return. And SARS is going to increase the list published in the Government Gazette of the sins that you commit that will give rise to a fixed amount penalty, because that is easy collection process. And we've already seen as individuals a big change to the rules affecting the penalties, because previously it was one or more returns outstanding. And now it is one return outstanding from the 1st of December 2021. So if your 2021 return is outstanding, that is one return outstanding, it is currently late, and you'll be getting a fixed amount penalty of between 250 Rand or 16,000 Rand a month for 36 months, or until such time as you rectify the problem. And the whole fight about whether your return is late or not late is certainly going to be under the spotlight, because many people believed that because they were rendering a provisional tax return in August and in February, that they were a provisional taxpayer as defined, and therefore were granted until the end of January and not the end of December to do their return. Now, the problem that one has is that when you look at their 2021 tax return, they probably didn't meet the requirements of being a provisional taxpayer, because they didn't have interest, taxable interest, or taxable rent, or taxable distribution from a rate that exceeded 30,000 Rand. And if you didn't have that, then you're not a provisional taxpayer. And so even though you were rendering a provisional tax form, it didn't by implication mean you're a provisional taxpayer. Also says SARS. We will try to argue that at some point in time you were asked to do a provisional tax return and therefore fall within the definition of a provisional taxpayer until you were told not to do a return. But one must remember that one is fighting about 250 Rand a month. And so how much fight can you really put in for 250 Rand a month? Otherwise, you'll pay us a lot more than you would have paid SARS. Now, we won't be unhappy with that process, but I'm not sure that it is in everybody's interest. And so as part of this process in the budget speech, it was announced that the entire provisional tax system is going to be reviewed. It might mean that we'll pay provisional tax more often than twice a year with a top-up. It might mean that the rules will change completely, but it's certainly something that is going to get reviewed. Now, one must remember that when you are working offshore and you meet the day's test, you used to be completely exempt from tax in South Africa. But in March 2020, the rules changed, and it is only 1.25 million that is exempt. And that led to many people who had left the country many, many years ago, regularizing their ceasing of residence. And so if you are working offshore, one needs to give proper consideration as to whether or not your tax residency status changed. Now, it's not your citizenship. Nobody's saying you must disavow your citizenship. It is your tax residency and the implications that that has with the tax authorities and the Reserve Bank. So now when you cease to be a resident for tax purposes, it means you are either no longer ordinarily resident because you're not meeting that test anymore, or you have broken the test by virtue of a double taxation agreement. Now, in this budget speech, Sars has indicated that they are going to look at the interest exemption and the capital gains tax exemption to ensure that there's no double dipping in the year that one ceases being a resident. And many of the DTAs, the double taxation agreements, set out a tiebreaker set of rules that would lead you to cease residence. Some of them are very, very specific and not within this ordinary bounds. And so they will have potentially significant capital gains tax consequences immediately upon reaching that country or becoming a citizen of that country. Some of them give you a period before it becomes effective. And so this is stuff that you need to take specific advice on, because there are consequences when you cease being ordinary resident. Now, when you make the application to SARS to confirm that in their mind they agree that you've ceased being ordinarily resident, they will potentially seek a lot of information for you, which you'll be able to see on the slides when they're sent to you after this presentation in some detail. And this will allow you to see the type of questions that SARS will ask when you cease being ordinarily resident. And once they've gone through that process, SARS will issue a document confirming your non-resident tax status, a very important document, because as we've said, that will affect your income tax position. It will affect your income tax position on remuneration, on interest, on non-South African sourced income. It will affect your capital gains tax transactions going forward, and it will affect your estate in that you will have ceased being ordinarily resident in the Republic. So this is a very important document that is now being issued so that you know where you stand. We'll look at a few other issues that are important because they have an impact on most people's tax position. So Section 7C, we must remember that that is coming up at the end of March for you to make your payment on Section 7C, and that is where there's an interest-free loan to a trust or an interest-free loan to a company owned by the trust, and all of these things. And there are also preference share schemes that were introduced and are part of the anti-avoidance process. So there's a cost if you make an interest-free loan to your trust. You take the deemed interest calculation and you apply the annual exemption for donations tax, and then you apply the donations tax percentage. So on a 2.5 million rand loan granted during the 2022 tax year to your trust, you will end up paying 2,904 rand and 11 cents at the end of March. So during this next little while, calculations ought to be done for you to ensure that you're making the necessary disclosure timeously. Just to highlight again that distributions from foreign trusts are no longer completely exempt in certain circumstances. So when you own 10 to 50% of a company owned by that foreign trust, then the ultimate dividend flow in a subsequent year after the dividend is declared would be exempt. But if you own more than 50% in that foreign company, then it will be taxed like a normal foreign dividend. So that's an important change from not too long ago. Also, the change in the doubtful debt allowance, also not so long ago that was implemented. So I must make sure that one is doing that calculation correctly. And remembering it is past due date. So if you give your customer 60 days, then it's 60 days plus the 120 days, or 60 days plus the next 60 days in order to determine which band you will fall in for the doubtful debt allowance. And we highlight here, and we highlight again in the little tax guide that you will get a link to once again after this, and it is available as a link on the PKF website, and many of you will be given a hard copy of the tax guide as well. We highlight in the doubtful debt section that one can make an annual application to SARS on certain criteria if one wants to expand this 40% allowance upwards, taking into account much older debt if one has that in one's books. So that's an important planning tool as well. So I'll just look at a few tax cases that have an impact. And you know, the unfortunate thing is income tax has created more criminals than any other single act of government. The unfortunate thing, I suppose, from a SARS perspective, is they're not finding too many of those criminals. Now, there was a case, the Rapper case. It was last year, and it had a number of iterations in this court case. It's now gone down a rather nasty road because Rapper was doing some very illegal VAT things, so alleges SARS, and so their court case is now taking a different tack. But these initial court cases dealt with the time period to complete an audit. And so they are very important for those who are having VAT audits, who need to get their refunds to run their businesses. This is where we can assist you with longer delayed refunds of substantial amounts that one might need to take other interventions to ensure the refunds are collected. But one must always remember that in doing these fights, one must have what's called clean hands. One must be up to date in one's tax affairs, and one can't have those little skeletons rumbling around in the proverbial closet. This court case looked at valuation consequences. In the planning, the sale of the 50% shareholding was done for a substantial amount of money, one would have thought, at 547 million rand. But 547,000 rand, sorry. But the actual sale valuation, as determined by SARS after a detailed audit, was 274 million rand. A significant variance between the valuation of the taxpayer and the final valuation after a court case. This will highlight to SARS the difficulty that they are wanting for those with more than 50 million rands of assets to do valuations. But it's very, very important when there are sales inter-group, sales between connected parties, that one must ensure that the valuations are fair and arm's length. Now, the Perry Formwork case looked at a late payment. The payment was due on Friday, 5 January, and the payment was made on Monday, 8 January. It was because there was not sufficient money in the bank account, and so the taxpayer was able to make a case that this was a first offense and that there were reasonable grounds for the late payments. But that one business day would have cost a significant amount of money, and it is very, very important when it comes to the payment of one's taxes Now we got provisional tax at the end of February. Do not leave it to the last moment in case there are problems with your payments. Ensure that your payments are made timelessly. Otherwise, penalties are significant. This case, I just highlighted because this taxpayer had 2 motor vehicles, and mysteriously and miraculously, he would only drive 1 motor vehicle and not use the other motor vehicle at all for business or private for a period. And then he would swap and use the other motor vehicle exclusively and no longer the first motor vehicle. Once again, only 1 motor vehicle at a time. And he did that for 3 years in a row. The judge was not impressed by this, and the taxpayer had no reasonable explanation for what was being done. Now, understatement penalties is really where a lot of our focus with SARS is. And when you seek advice, the question still remains whether you took reasonable care or not. In this case, the court held that the seeking of that advice was reasonable care, but that is not the SARS approach on matters. And so each of those fights of reasonable care, when you are a smaller taxpayer, will be fought bunker to bunker, trench to trench, as we engage with SARS in seeing whether understatement penalties should be imposed or whether it is a bona fide inadvertent error that occurred. Now, prescription is a wonderful defense, but you need to have answered the relevant questions on the return correctly. In this case, the simple, incorrect answering of a yes/no question meant that there was no prescription in respect of the tax affairs that arose from that particular question. And nowadays, there's a specific question for crypto assets, crypto trading, crypto assets in your assets and liabilities, and crypto trading in your income. Disclosure is required, or the non-disclosure will mean that your return is not protected by prescription. So let's look at a few other reminders of things that are important. I remind you again about the need to maintain details of your improvements to buildings, because the date of your sale of that residence or that industrial building may be many, many years after you did the improvements. But it is only at the time of sale that you have to justify the expenses incurred in improving that building for your capital gains tax calculation. We have seen this in practice, and it wasn't a pretty sight. You must maintain the information relating to the improvements. Now, home study. Everybody wants to claim the home study because during the lockdown and during this new blended approach that business allows, one is working partially at home and partially at work. But it is not as simple as that. You must realize that in all probability, your return will be subject to an audit. And SARS wants to see the actual cost. Not I think my rates are, and I think my electricity is, and I may be paying this or that. They need the actual expenses. And they want proof that the room that you are using as your study, the size of that room in relation to your home, because it's only on that ratio that your expenses are allowed. Now, if your room is used by yourself in your business, and your spouse in their business, then you don't qualify because that room is not used wholly and exclusively by you in your business. If that room has a spare bed in it that people can stay when they visit you, other than in COVID circumstances, then once again, you do not qualify. And if you don't use that room mainly, being more than 50% if you are an employee, then once again, you have a problem. So it is not a simple claim. There are complexities with that claim, and the claim will result in adjustments to the primary residence rebate when you ultimately sell that house. So please give proper consideration to that claim. We all know about load shedding. We all know the implications of load shedding, and the solution is solar. Solar allows you a deduction if it's used in your business, so give consideration to that solar process. Now, those of us in KwaZulu-Natal and Gauteng still remember the July uprising and the consequences that came there too for many, many businesses. Those were involuntary disposals where your business was destroyed, your building was destroyed, your stock was destroyed, your equipment was destroyed, and there is rollover relief. All you need to do is ensure that you meet the requirements. So we've sent out a newsletter not so long ago on this, and it is something that you would need to take advice on and possibly get a formal opinion on, because the amounts are generally quite large. But if you replace the asset that was destroyed within a defined time period and bring it into use in another defined time period and spend the right amount of money that you received on the new assets and buy the right type of assets, then there will be rollover relief available to you, that you won't have a capital gain in the 2022 tax year, and you won't have a recoupment of wear and tear previously claimed on either the building or your fixed assets. So it's important for now for your provisional tax. It's important for your business that you give proper consideration to this and to take advice on this. Unemployment, if it's not been hammered through enough, then we'll hammer it through some more. It is a significant problem for our country, and each person, each business needs to do something to try to reduce the level of unemployment. There is an incentive. There is the employment tax incentive that is there. And even as it stood prior to the current amendment, it was a beneficial incentive to encourage you to employ somebody, even if it was only for 12 months. At 2,500 Rand, the cost to you was only effectively 800 Rand. And now, with the new enhanced allowance coming through from the 1st of March, your actual cost will reduce down to 300 Rand for that first year employing somebody at 2,500 Rand. If that is not enough of incentive for businesses to go out, to hire people, to employ people, even if it is for 1 year, preferably for 2 years, your allowance is slightly less in the second year, but still significant. Employ people, allow them a work opportunity. Once you have them in your company, you'll find a need to retain them, or at least you give them something for their CV for another job. But we all need to do something to reduce the unemployment. It's a few days before the end of the tax year, and so if you haven't made use of your tax-free investment for the year ending February 2022, then rush out and do that and begin that process. And then remember in the first week of March to do the same. Don't invest more than the 36,000. It's a very costly mistake, as I know somebody who has done that costly mistake, and not me, of course, but it's a very costly mistake. So make sure that you don't invest too much in any 1 year, but it is important to do so. Now, the tax ombud is an important part of the tax system to try to ensure fairness and equity in the tax system. they've released a compendium of all the obligations and rights of taxpayers. It's a start towards a Bill of Rights for taxpayers. People are urged to look at it and to give consideration to both their rights and their obligations. Now, we always say, bring back those good old days. But in those good old days, our corporate tax rate was 50%. Our equivalent of dividend tax was 25%. We have come a long way, both in the country and in our taxes, since the so-called good days. Let us have the hope that our future will be bright, and let us remember how this budget speech actually went. Throughout the entire speech, the rand remained strong. It weakened this morning, but primarily because of the Russian invasion in Ukraine. During the tenure of the speech, the rand actually strengthened. The world showed confidence in the Minister of Finance and what he was saying. He didn't have any radical departures from his predecessors, and it certainly didn't treat him like it did our weekend Minister of Finance. We have a solid Minister of Finance who is saying the right things, who is planning for us to have a fiscal surplus in the next year, and who is ensuring that we are using the surplus we receive from the mining industry to reduce our debt requirements and not just increase our expenditure. I thank you all for listening. I hand over to Ziad, who will facilitate the questions and answers and to bring the panel into the process.
Well, thanks. That was fantastic, and I think a great end, just reminding us in terms of the importance around businesses' contribution towards job creation and improving the lives of South Africans generally. And always great to get your insights. The minister's speech only tells one side of the story, but as we know, the devil's in the detail, and really great in the way that you've broken down some of the announcements coming out of the detailed budget analysis that accompanies the minister's speech. So I think, as Paul said, we're dealing with the question and answer section of the program, and we've got representation from pretty much all of the various PKF offices in South Africa. Just to run through our panelists again, we've got Kubashni Mudli from the PKF Durban office. Kubashni's got a focus predominantly on transfer pricing related issues and corporate restructures, and lends their expertise towards those facets of tax. We've got Dion from the PKF Port Elizabeth office, who deals predominantly with PAYE, employment tax incentives, and individual tax matters. And we've got Mohammed Mayed from the PKF Johannesburg office, who deals really with a wide variety of taxes, including corporate restructures, individual taxes, and most recently has written a few opinions on cryptocurrency, which is quite interesting as well. There have been a couple of questions that have come through during the course of Paul's discussion. We'll try and get through as many of those as we can, time permitting, and to the extent that we're unable to do so, we'll either try and respond in the Q&A box, or alternatively, we'll try and make contact with you via email post the session. Again, our details, I think, are up, so if there are any questions post the session, you're welcome to just send those through. But I think, Paul, just to come back to you for a minute, aside from sort of before we get into the tax-related matters, just from an economic perspective, I think one of the things that came out again as part of the minister's speech was this threat to the fiscus and the worsening of our financial situation as a result of increasing public sector wage bills, and the need really to stem that. I mean, obviously, the unions are not going to take that very lightly. We know there is a job summit with the minister, or public sector wage summit with the minister later in this month. Do you think there's room from a political perspective, and does the minister have the clout to be able to push something through? Where do you think we stand on that?
I think everybody is waiting for the Constitutional Court to rule on the application that's before them on the previous salary rules and the decision of the then Minister of Finance to not implement the previous agreement, and whether that was lawful or not lawful. So I think everybody's waiting for that decision, because that will have an impact on everything going forward.
Clearly the ANC is walking a little bit of a tightrope here. We are starting to head into elections in a relatively short while. We've got unions to contend with, and in addition to that, we've got the social grant that seems to be extended on an ongoing basis. We've got, I think, 46% of the population now receiving some form of grant. Treasury's recognized that comes at a substantial cost and is not sustainable in the long run without significant rate increases. Dion, Paul's touched on the fact that there isn't really much scope to increase rates any further. Where does government go looking for the extra funding to sustain these additional costs, and particularly the socioeconomic development grants?
Yeah, Ziad, I think the first thing is just to have a look at what's happened. I mean, social grants, they've been around for a while. I think it's just been picking up as a result of COVID. I think it had a massive impact, and there was the special COVID grant, which is still with us today. So obviously that needs to be funded. I think Paul's also spoken a lot about the employee tax incentive. I think the real thing in terms of getting additional taxes rather than changing any tax rates, and I think his options are quite limited, is just if we can get to a place where the country has economic growth, we attract investment, and whether we'll attract sufficient investment to the reduction in corporate tax rates, we'll need to see. We're still a bit high at 27%. I think we've got a risk that we're losing, quite a lot of high net worth people that are leaving the country. Yes, they might collect an exit charge as they leave, but those people typically would have provided skills. They would have trained people up. They could have been business owners, which in turn would have, contributed to personal income taxes. So I think one's got to look at that. I think, yes, the ETI incentive, it's good news that we've got increases, and hopefully we'll get more people out of social grants and get them into the employment sector. If you've got them on for a year or two, it gives them opportunity, it gives them work experience. So I'm hoping that we can, utilize that without any of the schemes that we had previously. I think, if you look, where can you go? In terms of personal income taxes, I think it was, the right decision. We already, if you look at, who's paying the taxes, it's a small percentage of corporates and, individuals that pay a lot of these contributions. I mean, Paul showed in his slide, be nice to those taxpayers because they pay the bulk of these grants and other taxes. VAT increase would have been quite difficult. There were some calls maybe that you look at maybe, higher value assets and maybe have a different rate. But the moment you've got different rates on VAT, it also becomes an issue on enforcement and how do you police that, and is the cost benefit really worthwhile? So also on the fuel levies, I think it was beneficial that the general fuel levy and the road accident fund levy didn't change. But there is a little bit of a fuel increase that's going to come. The carbon fuel levy, it's a couple of cents. It'll come in April, but it's not that massive knock we had in the past. So, in general, I think he did what he could. But ultimately, I think if we can get the economy to a place where we can grow the economy and also, show to the world that we're serious about dealing with state capture and all the effects on that, then, hopefully the growth and maybe getting more people into these schemes like Paul's example showed us, for 2,500, the true cost only 300 Rand, the opportunity that could give to youths coming out of a system. I mean, it's over 50% youth unemployment. So I think that's an issue we need to deal with. And there's limited space. And I mean, the minister made it quite clear in his budget speech yesterday that you've got limited options to increase taxes going forward.
Yeah, Mohammed, Dion touched on sort of this economic recovery and growth sort of automatically generating additional taxes. But I think SARS surely has got to also start looking at enforcement and collection measures. We've seen them start to police, particularly the illicit economies, tobacco and gold, I think in particular. What have you seen coming through? Is there any movement in those sectors? Is SARS raising additional revenues from those areas? And is it sustainable in the long run?
Yeah, thank you, Ziad. I think definitely from this budget speech, what we've seen through after the budget was presented, the commissioner had a post interview and he alerted the public to about 650 investigations currently underway in these various sectors, illicit economy, which involves a whole lot of trading that is taking place across various sectors. And I think, on the broader scale, these investigations has either led to, enforcement action in various forms, being civil assessments being raised on the one hand, and on the second hand, criminal prosecutions taking place. Now, yes, the 650 is a small number, but it's a start. And what I think is going to transpire in the coming year and possibly in the next 2 or 3 years is that the increase of enforcement action in these specific illicit economy trades, be it tobacco, gold trade, or any other form of illicit economies that has been identified. Together with that, we've also seen that the strategic focus is to put resources in these specific business units to actually ensure that they're fully capacitated, they have the resources, and they are asking more questions, they are doing more investigations. So sustainability-wise, yes, in the short term, there is a short-term gain for SARS. And if it is giving SARS success, what we have seen, they invest more in something that gives them a lot of money, and they'll continue on that basis going into the future. So for sure, there is a short-term and possibly, a long-term gain out of it.
Kubashni, all of this sort of sounds, that SARS is going after additional sources of revenue from existing taxpayers rather than looking to new sources or rate changes. And I mean, this speaks to the penalty regime that we've started seeing of late being applied to a number of taxpayers. What are you seeing out of the Durban office? Are we entering, this huge penalty regime? What do taxpayers need to be aware of and be careful about?
Thanks, Ziad. Yes, I think, there's a lot of areas in which we can look at raising taxes. And SARS at the moment is really putting a lot of effort into enforcement, and they have been raising numerous penalty assessments. Particularly the admin penalties, we've seen a lot of assessments come through in the last few months, particularly for the non-submission of tax returns. So as Paul mentioned, for individuals that have tax returns outstanding, previously you had to have at least more than one outstanding. And now from January this year, if you've got one return outstanding, you are triggering a penalty assessment. For companies, similarly, outstanding returns from 2009, provided you've got that final demand and you haven't rectified the situation, you are going to have those penalties imposed. So we're seeing a lot of those types of penalty assessments that are coming through. Even for provisional taxpayers, we have had so many clients of ours that assume that they were provisional taxpayers, and SARS have come back to say that you're not actually meant to be a provisional taxpayer. You shouldn't have taken advantage of the extended deadline for provisional taxpayers and have now levied these administrative penalties. In some cases, they're not all correct. There were some taxpayers that should have been provisional taxpayers and have actually been imposed with these penalties. And of course, now as a taxpayer, you must then try and fight SARS on these, ask for requests for remission on these penalties, and that which also can be a costly exercise. In the budget, they also mentioned the potential imposition of understatement penalties on the ETI. And as you know, the ETI table is the USP table, the understatement penalty table, is based on behavior. So where you've got, for example, in the ETI space, ETI claim exceeding R1 million, you've got a 10% penalty, or where SARS looks at you not having taken reasonable care, 25% penalty. And these can go all the way up to 100% penalty where there's gross negligence. So these penalties can stack up very quickly. And I think we all need to realize that these penalties are going to be more of the norm going forward, with more and more notices being issued by SARS for non-compliance. And taxpayers will have to then ensure that their tax affairs remain compliant so that these penalties aren't unnecessarily imposed.
Yeah, thanks, Kubashni. I think, Mohammed, you can't have this discussion around additional sources of tax revenue without, having a bit of a chat around the noise about donations between spouses potentially falling into the donations tax net and becoming taxable. Is this still something that's potentially on the cards? What do taxpayers need to be aware of? And can you just expand by what we mean by donations being between spouses becoming taxable?
Yeah, sure. So currently, as the legislation stands, there are certain provisions regarding donations between spouses, and the exemptions that apply around donations between spouses. What has come to the light is there's a discussion around Treasury and SARS as to how do they then go forward in terms of this area. And this area has been some focus, there's been a lot of debate, there's been discussions, and I would think in this year, we're going to see some discussion paper going up to the October medium-term budget policy statement as to how they want to treat donations to spouses going forward, what those proposals are. Will they still keep the exemption? Will they drop the exemption? So one needs to be aware of this. One needs to take cognizance that how do we plan for estate planning purposes, or for that matter, moving donations between spouses going forward. Overall, I think it is going to get momentum for the mere facts here that you've touched earlier on. Where are the other revenues that SARS could look at? Penalties, we know that's coming, the illicit economy, and the enforcement or the increased enforcement actions that are taking place. And this particular area of donations tax definitely is taking momentum. So we'll definitely see something this year.
Kubashni, we're talking about raising taxes from additional sources and where government needs to look to fund our expenditure. Yet the corporate tax rate has reduced from 28 down to 27, or will be reducing. It almost sounds counterintuitive. Where's the Minister and Treasury's headspace at? What does that mean for potential reductions? And what's government thinking there?
Yeah, my view on that is, obviously as an economy, we want to stimulate growth. And part of that is to allow foreign investors to look at South Africa as being a competitive environment in which they want to start businesses. So it was mentioned in the budget documents, and Paul touched on it, that the current global average tax rate for developing countries is 23%. So you can see at the moment, South Africa is sitting quite high as compared to the global norm for developing countries. And so we still have a way to go to become competitive and for foreign investors to want to place their funds here. But I think from a strategy perspective, I think Treasury and SARS are looking to actually reduce the rate in the medium to long term. They did say this in last year's budget, and of course there was some submissions being made by tax practitioners and public to say that you're wanting to bring down the rate, but you're also taking away some of these deductions to fund that rate reduction. I mean, if you just look at the interest on foreign loans, the interest deduction on foreign loans, it used to only be applicable to residents that were basically granting loans to foreign loan holders that were not subject to tax in South Africa. So there was a DTA between South Africa and that country saying, we are paying out a withholding tax, but it's at a rate of 0%. And now they've actually extended this regime to say that when the corporate tax rate takes effect at 27%, the individual or the foreign loan holder, even if they were subject to a 5% withholding tax rate, for example, that they would also be subject to this limitation of the interest deduction. So that's quite a wider application of this provision that we've seen that's been in existence for a while. And in addition to that, they've also reduced some of the percentages. So before you would have got a deduction of 40% of your EBITDA, and now they've reduced it to 30%. So they have made fundamental changes to sort of fund this reduction in the corporate tax rate to ensure that the tax base is not eroded. And in addition, Paul also mentioned the limitation on assessed losses to 80% of taxable income where your assessed loss is greater than $1 million. They've also done things like put sunset clauses on various incentives. For example, your port assets, your employee housing loans have basically all come to an end. So whilst they might have looked at it as, or some people might look at it as counterintuitive in reducing the corporate tax rate, they've actually taken away quite a lot of incentives. And I think going forward, we will see even more incentives and allowances being taken away in order to actually reduce the corporate tax rate even further.
Kubashni, as part of the budget documents, I think on the same vein of raising additional taxes, was this concept around extra disclosure required for taxpayers with assets over 50 million rand. What does that mean? What's it all about?
So currently our legislation requires provisional taxpayers with business assets to disclose their statement of assets and liabilities. There's no minimum threshold on that. So the proposal has now come through to say where a person has more than 50 million rand worth of assets, they now must disclose those assets at market value. So currently we are disclosing them at cost, but from the 2023 tax return, if you do meet this threshold of 50 million rand worth of assets, you now need to disclose at market value. Market value, as Paul mentioned as well, does come with its own complexities. The compliance burden that would then be placed on taxpayers in determining what is market value is something that needs to be explored further. I think there will be a lot of public consultation before this market value is adopted. I mean, for the group of companies situation, for example, if you're the shareholder at the very top group company, how are you going to work a market value on that company's shares? I mean, are you going to have to value every company below that? Surely you would have to get a market value of the holding company. And as we all know, valuation experts don't come cheap. These costs can escalate very, very quickly. Some of the reasons that I thought was quite interesting in the document that they published with regards to the reasons for wanting this disclosure. Firstly, to detect any undisclosed assets or partially disclosed assets. That was the first reason that they gave. To me, this doesn't make a whole lot of sense. Firstly, because we have what Paul also touched on is the common reporting standard, as well as tax information exchange agreements with various countries. So SARS already has a lot of information that other countries are reporting to them on South African citizens, bank accounts located in foreign countries, income that's currently sitting in those bank accounts. So there's quite a bit of information that's being gathered at that level. They've also had the Panama Papers and the Paradise Papers, which effectively was leaks of information that resulted in over 2,000 South African residents implicated. So at the moment, my view is that there is sufficient information at SARS's disposal currently, and they have employed a significant number of new staff to ensure enforcement. And really what they need to do now is to ensure that they do conduct these audits properly so that they can identify those undisclosed assets and income, as opposed to now increasing the compliance burden on taxpayers to say now to start disclosing your assets at market value, because I don't think that's really going to achieve much. And also where clients haven't disclosed these assets and obviously don't want to be subjected to these SARS audits, we have had amnesties, we've had VDPs in the past. These have obviously come to an end, but we still do have the permanent VDP that's contained in our Tax Administration Act, where you can actually go to SARS and say, I have undisclosed income, I would like to come forth and make disclosure to ensure that you don't end up having a SARS audit and they're imposing a 200% intentional tax evasion penalty. So that really deals with the first reason. And then if I can just touch on the second reason in the document, they basically made reference to a recommendation by the Davis Tax Committee to determine levels and structures of wealth. The Davis Tax Committee, for those of you that aren't fully aware of what that is, so that was basically a committee that was put together a few years ago to look at the different tax structures in South Africa. And one of their tasks was really to look at whether or not we should introduce a wealth tax in South Africa. Their report came back saying that there were a lot of complexities to introducing a wealth tax, but as a first step, they actually recommended that all taxpayers above the tax threshold disclose assets and liabilities. So obviously this proposal, thankfully, is not as far-reaching as that, because I'm sure not all taxpayers want to be disclosing the assets and liabilities to SARS. And so this proposal to only target the greater than 50 million, which I guess SARS would view as their high net worth individuals, to illustrate and, well, in their mind, sort of mitigate against the inequality in South Africa. So there have been numerous statistics published with regards to inequality in South Africa, with 10% of our population being responsible for 90% of our wealth in South Africa. And that's not just income wealth, that's also talking to asset wealth. And we also, a lot of the inequality effects in July when we experienced the unrest in Durban and parts of Gauteng. So inequality does need to be addressed, but introducing a wealth tax, we may even run the risk of high net worth individuals exiting the tax net. And when we saw the introduction of the foreign tax employment exemption, we saw a significant number of wealthy people ceasing tax residency in the last 2 years. This is going to end up in a permanent loss to the South African tax base and, of course, a reduction in tax revenue. So whilst this proposal seems to be aimed at a possible introduction to wealth tax to try and combat some of that inequality, the country might end up having dire consequences in the long run because we might just be eroding our tax base even further.
Kubashni, you've obviously touched on the sort of 50 million rand impact, which I must say does impact just a relatively small group of taxpayers. But one of the things that does impact quite a large group, and in fact, most people in South Africa, Mohammed, is this proposed changes to retirement funding and this concept of a two-pot system. There's been a lot of white papers that have been, a lot of draft legislation that's been published, a lot of consultation. Can you maybe just break down what we are talking about when we refer to a two-pot system and where we're going with this?
Yeah. So Ziad, you're right. There has been a lot of consultation, and I think public comments were supposed to be in by the 31st of January, but I think that may be extended further into maybe March or April. But let us just maybe unpack the two-pot system and understand what it is. The two-pot system entails, firstly, to take the retirement funding, given the COVID period and pre-COVID period, and just where South Africans are generally in terms of financial commitments and debts and otherwise. And taxpayers want access to the retirement in whatever form or way before retirement, leave jobs, get onto a new job. They cash out their pensions and they use that to settle their financial commitments. So what the proposed document is talking about is a two-pot approach. Firstly is to have a third in one pot and 2/3 in another pot. So what would happen is the 2/3 will remain in that pot to sustain a taxpayer upon his or her retirement at retirement age. And the third is where you could access those funds for whatever means that I've mentioned earlier on, to settle your financial commitments, debt, or other financial obligations that you may have. So the proposal talks about this two-pot system, keep the 2/3 because government would not have the money in 20 years' time, in 30 years' time to fund your retirement. So there's some safeguard around that to say, let's think about a split to help you in the short term in pot one, the third, and then in the long term still give you some benefit upon retirement. Now, obviously, these have big implications for the retirement fund companies in South Africa per se, you can imagine. And that's why this public consultation and this draft documentation is out for comment. One would now need to see in the coming months as to what the final mechanisms would be. How would the 1/3 work? How would you access that funding? Can you access it once a year? Can you access it more than once a year? Can you just take all the money in the 1/3 as one go? Are you entitled to take more every year? All these type of practical questions will need to be answered in the details that will come out during the course of this year. So in a nutshell, those are the two pots of the two-pot system that we talk about, third and the 2/3 split.
Thanks, Mohammed. I am conscious of time, even though we've still got a number of questions to get through, but I think those that have posed questions will try and get in contact with you post the session to answer them. I think just before we close off, I'll ask each of the panelists just for 10 or 20-second overall view on your feelings on the budget and any final comments just before we do close out in a little bit of admin. So Paul, maybe just with you.
Yeah, I think it went better than we thought. I think everybody is apprehensive. We have a new Minister of Finance. I think it went better than we thought. I think we're on the right track. They just need to control the expenditure to within the limits agreed. So the excessive expenditure, the corrupt expenditure, if they can control that, then we're on the right track.
Dion, final thoughts?
Yeah, just quickly, I think even from the SONA, it was quite clear that government's looking at private sector to help deal with the unemployment crisis. So it'll be interesting just to see these small business loan guarantees they've introduced yesterday. And there's also the equity link where they're going to try and have a turnaround for small businesses. So it's good to see that government's serious about small business. But overall, yes, it could have been much worse. So probably not a bad budget in the end.
Kubashni?
Thanks, Ian. I think it was a fairly straightforward budget. There were no major surprises or changes as anticipated. The implementation date for the reduction in the property tax rate was, of course, welcome. But I think we all just need to keep our eye on that government debt that's just going out of control. And with the pandemic and the unrest that's been experienced, I think we're really going to struggle to overcome that. But we still remain optimistic for 2020, and we hope that somehow they will be able to control that government spend.
And last but not least, Mohammed.
Thanks. Yeah, so I think just items that come to mind in my summary. The first is a cautious budget. Secondly, the emphasis that we have seen coming from the previous minister, Mbowene's time, is the emphasis to bring the national debt down. And thirdly, there seems to be a new path of inclusive growth, trying to get the growth moving and taking us into a better direction from where we are. So cautious, reducing the debt, and a new growth path.
Fantastic, thanks. So just from an admin perspective, Kelly from the PKF South Africa marketing team will follow this session up with an email to all attendees, just with a copy of both slides, a copy of the recording of the session, and our tax booklet, which is hot off the presses as of late last night. Again, thank you everybody for joining us, particularly given the number of other webinars there are on exactly this topic. Thank you for choosing to spend your time with us, and we'll hopefully see you at one of our other tax related sessions later in the year. Cheers.